In the 21st century, the stock market has seen significant growth alongside an unfortunate rise in scams that take advantage of investors. While there are many types of scams, the following are considered the top 5 most common and impactful scams in the stock industry today. A pump and dump scheme involves artificially inflating or pumping the price of a stock to attract investors, often through false or misleading statements. Once the stock price has been driven up, those orchestrating the scam, typically insiders or manipulators, dump their shares at the inflated price, leaving the new investors with worthless stocks as the price crashes. Promoters spread rumors, create fake news, or hype up a stock on social media and message boards like Reddit, for example, Wall Street Bet's Twitter, or through fake press releases. The goal is to create a buying frenzy that artificially inflates the stock's value. Once the price reaches an unsustainable high, the scammers sell off their shares. The stock price then plummets, causing the remaining investors to lose money. GameStop in 2021. Although not necessarily a scam in the traditional sense, the GameStop stock situation involved similar elements of rapid price manipulation and volatility, with some calling it a pump and dump. Cryptocurrency-related pump and dumps also happen frequently, even though they're not strictly stocks. However, they follow the same pattern. Insider trading occurs when someone uses non-public material information about a company to make stock trades for personal gain. This can involve corporate executives, employees, or anyone with access to sensitive information. A company executive or insider receives confidential information such as earnings, reports acquisition news or mergers, and uses that information to buy or sell stock before it becomes publicly known. The practice gives unfair advantage to those with access to insider information, allowing them to profit before the market reacts to the news. Martha Stewart in 2001. The celebrity businesswoman was convicted of insider trading for selling her shares of the biopharmaceutical company Imclone Systems based on non-public information. Raj Rajaratnam in 2009. The hedge fund manager was convicted for running a large insider trading operation, using tips from corporate insiders and others to make millions. A Ponzi scheme is a type of investment scam where returns to earlier investors are paid using the capital of newer investors, rather than from profits generated by actual investments. This type of scam is unsustainable and eventually collapses when the flow of new investors slows down, leaving those at the bottom of the pyramid with significant losses. The fraudster promises high returns to investors, often much higher than what would be expected in traditional investments. New investors are recruited, and their money is used to pay returns to earlier investors, creating the illusion of a profitable business. As long as there is a constant influx of new investors, the scheme continues to work. Once the influx slows or the operator is unable to recruit more investors, the scheme collapses. Bernie Madoff's Ponzi scheme back in 2008 is the largest in history, defrauding investors of approximately $65 billion. It lasted for decades and affected thousands of investors, including high-profile individuals and institutions. Scammers create fake investment platforms that offer high returns on stocks, cryptocurrencies, or other assets, luring investors with promises of guaranteed profits or low-risk, high-reward opportunities. These platforms often appear professional but are designed to steal investors' money. The scammer creates a seemingly legitimate trading platform or app, often with flashy websites, mobile apps, and fake testimonials. The platform claims to offer unrealistically high returns, often with a guarantee of making money. In some cases, the platform might allow withdrawals initially to build trust, but later, the scammer locks the investor out and disappears with the funds. These scams can target both beginners and experienced traders who may be lured by promises of easy money or minimal risk. BitConnect, back in 2017, was a cryptocurrency-related Ponzi scheme that promised high returns to investors, only for the platform to collapse once its operators shut it down. Plus Token in 2019 was a similar scam involving cryptocurrency promises, where billions of dollars were defrauded from users worldwide before the platform was exposed as a fraud. Front-running occurs when a broker or institutional investor executes orders on a security for its own account, while taking advantage of advanced knowledge of pending orders from clients. A broker learns that a client is about to make a large purchase or sale of a stock, and knowing this will affect the stock price, the broker buys or sells the stock first to profit from the anticipated price movement. It is a violation of trust and ethical standards, as the broker uses information that is not available to the general public to profit. The SEC crackdown 2015. The U.S. Securities and Exchange Commission, or SEC, has taken action against multiple instances of front-running, particularly involving large institutional trading firms. Promises of high, guaranteed returns. Scams often promise returns that seem too good to be true, typically much higher than the market average. Pressure to act quickly. Scammers often create a sense of urgency, urging investors to make quick decisions to avoid missing out. Lack of transparency. Scams tend to avoid providing clear and verifiable information about the investment strategy, company, or fund involved. Unregulated platforms. Always ensure that the platform you're using is regulated by a legitimate authority, like the SEC in the US, FCA in the UK, or similar bodies. Suspiciously professional websites. A slick, polished website does not guarantee legitimacy. Scammers often invest in high-quality websites to deceive investors. The stock market can be a rewarding place for investors, but it also has its fair share of scammers seeking to exploit those looking to grow their wealth. It's essential for investors to remain vigilant and do due diligence when considering investments, avoiding promises that sound too good to be true. Regulatory authorities like the SEC and CFTC in the US play a crucial role in protecting investors. However, investor awareness and education are equally important in staying safe from scams.